In this video, Peter and I will be introduced to 8 dividend stocks that are in line with Warren Buffett's investment philosophies and have the potential to generate over $1,000 a year with little risk. There will be 2 sections to this video. The first, and perhaps most important, section will go over why companies pay dividends, what investors can expect from them, and potential pitfalls to watch out for. Don't skip this section because we'll be sharing all the details that can help you outsmart the majority of dividend investors. After that, we'll look at 8 outstanding dividend stocks that, if you choose wisely, have the power to drastically alter your life and increase your wealth. So, without further ado, the reason why businesses pay dividends is that when they do turn a profit, they must decide how to use that money to increase productivity. They have a few good options, such as simply reinvesting it, in which case a startup company in growth could decide to use the funds to improve their products and increase their market share. However, if a company chooses to turn a profit, they also have the option of paying cash dividends to shareholders by simply owning dividend-paying stocks. As per the regular timetable, you can receive a cash dividend payment every quarter, every 6 months, or even every month. However, if you reinvest these dividends over time, the impact can be quite significant. Currently, many people who are looking for dividend stocks make the mistake of selecting firms with the highest dividend yields, often over 10%, and making investments only with the hope of seeing short-term growth. This strategy is a grave error for a number of reasons. Firstly, it prioritizes short-term profits over investing in the core competencies of the business. Stocks are very dangerous for tomorrow, but safe for the long term, according to a quote from Warren Buffett. When it comes to dividends, choosing the stocks with the highest yield almost always leads to what experts refer to as a dividend trap. This is a situation in which investors are persuaded to purchase a stock only because of its high yield, without taking into account other crucial factors like the company's financial health, the sustainability of the dividend, and its prospects for future growth. In a dividend trap, the company may be offering an unsustainable high yield, typically in the double digits, because of declining earnings, deteriorating financial conditions, or an incapacity to generate sufficient cash flow to support the dividend payments over the long run. And if the business is compelled to reduce or stop paying its dividend, investors can wind up losing money, resulting in a drop in the stock price. As a suggestion, you might want to think about only investing in higher yields below 7% because it suggests that the company is doing well and that the price hasn't dropped too much already. We're not saying that all high-yield stocks are bad, but rather that you should pause and conduct additional research whenever you see a dividend yield of 7%. With that in mind, here are 8 of the best dividend stocks that are in line with Warren Buffett's investment strategies, which you and Peter should think about purchasing. Starting with PepsiCo, a household brand that we're all undoubtedly quite acquainted with, and that offers a wide range of items from beverages to soft drinks, which have a fantastic potential to yield $1,000 plus dollars in dividends every month. PepsiCo performs admirably in terms of profit generation, and guess what? They also own Frito-Lay and Gatorade. Their current dividend yield of 3.1% indicates health and is essentially in line with the companies that Warren wants all of us to invest in. You see, at the heart of his investment strategies, he places his bets on businesses that provide long-term value rather than on fads or potentially outdated technologies. Purchasing a fantastic firm at a reasonable price is preferable to purchasing a fair company at a reasonable price. PepsiCo is an incredible example of a well-run business that generates revenue from daily consumer purchases. However, since we're talking about Warren Buffett, you may be wondering why we're talking about Pepsi instead of Coke, which is ironically his preferred soda and actually pays off nicely. It all comes down to this. Whereas Coke excels in beverages, Pepsi does marginally better in terms of variety. However, Pepsi also offers fantastic consumer packaged goods, such as chips, which contribute to roughly 20% of their total sales. This is a positive development, because Pepsi will outperform Coke in that regard if you're looking for greater growth, and Pepsi is a fantastic firm that has established a name regardless of how difficult the economy is. Due to its moat and the strong demand for its products, Pepsi is likely to continue in business for the rest of our lives. globally now that we've moved on to the second company on our list, Home Depot. Before we get to the good stuff, do you recall that we previously mentioned that Warren Buffett only invests in long-term value companies? Well, this stock will help you and Peter cross the four-figure threshold indefinitely, in addition to being among the largest in its industry in the U.S. Home Depot is one of the safest and most stable firms in the world. In fact, it is one of the few that has outperformed the S&P 500 and NASDAQ over the past 10 years. Its dividend yield of 2.38% is again not excessive, but it is a good thing. With over 2,300 locations and $150 billion in sales over the previous year, Home Depot is the biggest home improvement retailer in North America. When it comes to revenue distribution, professional contractors account for nearly half of the company's revenue, with DIY customers making up the other half. This is important because the revenue distribution is stable. If one segment's purchases decline, the other will help to offset the loss. And let's not even talk about how durable the company is. Its 33% gross margins and 17% EBITDA margins mean that its dividend won't be going anywhere anytime soon. When you combine that with the fact that the U.S. home market is currently struggling because not enough homes are being built, Home Depot will undoubtedly benefit even more when demand spikes. Along with Lowe's, they've effectively monopolized the entire sector, which is a pretty strong economic. Furthermore, nothing greater will be found in its industry. Though Bo dresses this very nicely, we believe that more individuals should consider AbbVie when it comes to dividend investment. Remember when Warren Buffett said that value is what you receive and price is what you pay. Has its main office in North Chicago. If you're still not sure why you should include AbbVie in your portfolio, just wait until you see what it could do for Peter. This biopharmaceutical company has a portfolio of drugs in several industries, including neuroscience, immunology, and oncology. The stock price of AbbVie has changed by 16.52%. The medical company has paid a dividend of $155 per share thus far this year. By contrast, the large-cap pharmaceutical industry's yield is 2.67%. While the S&P 500's yield is 1.56%. The dividend yield of the medical firm is 3.43%. Ever heard of the medication Humira? This company developed an amazing drug that reduces pain and swelling associated with skin disorders and arthritis. It is one of the most successful drugs ever, consistently topping the list of best-selling drugs annually. They do fairly well in terms of sales when it comes to dividend growth. The current yearly dividend of $6.20 for AbbVie is 4.7% more than it was 5 years ago and 4.7% higher than it was last year. The company has increased its dividend 5 times in the past year for an average yearly increase of 8.28%. The payout ratio, or the portion of a company's yearly earnings per share given as dividends, and earnings growth will both have an impact on the dividend's future growth. Given that the American healthcare system is currently in flux, AbbVie is in a strong position in their industry thanks to their leading patents on a wide range of medications and their continued investment in research and development. As of right now, the company's payout ratio stands at 53%, meaning that 53% of its trailing 12-month EPS is allocated as dividends. The latter of which means they'll continue to broaden their product offerings, strengthening an already robust economic model. As for Mo8, if you've been paying attention thus far, you've probably heard us use it a lot. This is because the term is based on Warren Buffett's value investing principles, which were inspired by the water-filled trenches that surrounded castles to keep out invaders. Economic modes, on the other hand, refer to a company's capacity to sustain a competitive edge to safeguard its market share and profitability from competitors. Companies that possess these wide modes act as barriers to both competition and economic downturns, allowing them to generate higher returns on capital over a prolonged period of time. With excellent cash flow and extremely attractive fundamentals. In the long run, this proved to be successful, of course. But going back to JP Morgan, they have about $1.7 trillion in liquid assets, of which over $700 billion are cash. Additionally, it will reassure you as a shareholder because it will be quite impossible to find JP Morgan in danger of going bankrupt. Remember the 2008 financial crisis? Despite the fears and subsequent collapse of many large financial institutions, JP Morgan remained resilient, in contrast to firms such as Lehman Brothers. Furthermore, given the current trend of rising interest rates, JP Morgan is well positioned within the financial sector as rates rise. We predict that JP Morgan's net interest income will continue to rise, especially this year, as banks stand to benefit from the situation by leveraging the interest rate disparity between what they charge clients and what they pay out. And the next, if rates rise as the Federal Reserve continues to fight inflation, JP Morgan will profit. However, even if rates stay the same, you can still be confident that there are additional advantages to investing in ExxonMobil. The number 5 item on our list today is contentious for a reason, but the firm will still make it a promising pick. As you can see, this is due to its disapproval of green initiatives and the expectation that the U.S. reliance on oil will decrease over the next few decades. Nevertheless, fossil fuel dependency is still quite significant, and even though EVs are becoming more and more commonplace and fossil fuel is still king at the moment. And surprise what? Since 2023, one of the sectors that has outperformed is still energy. Hence, it only makes fair that Peter's portfolio includes his business from this sector. The oil and gas giants Chevron and Western Petroleum are among Berkshire Buffett's top publicly traded equity holdings. Additionally, Berkshire owns a 92% stake in Berkshire Hathaway Energy, which is worth more than the combined value of its holdings in Chevron and Western Petroleum. Although Berkshire does not currently own ExxonMobil, this is why we think it is the best option in the energy sector. Recall the days when refined oil products like petroleum gasoline and more started to command a premium on the market. Although it has been a while, the costs have not decreased significantly. Additionally, the ongoing conflict between Russia and Ukraine makes it unlikely that energy prices would decline very soon. Exxon is currently raking in the money and paying its shareholders a 3.78% dividend yield, or about $352 per share annually if you own them. However, Exxon has recently acquired Pioneer Natural Resources, with a deal expected to close in Q2 of this year, along with a sizable 26.32%. Exxon ended the quarter with $297 billion in cash on hand, $5.4 billion in operating cash flow, and $4.1 billion from asset sales. Exxon's capital expenditures amounted to $23.4 billion, leaving it with a total free cash flow of $36.1 billion, of which $32.4 billion was distributed to shareholders in the form of dividends and buybacks. If you thought that was impressive, consider this. At the end of the previous year, the company had $1.9 billion in excess cash on its balance sheet, demonstrating its ability to fund operations and maintain a generous share repurchase and dividend program. Moreover, Exxon has a stellar track record over the last 10 years, with solid yields on its dividends. But what really makes their capital return program appealing are the buybacks. Next, Exxon should be added to your portfolio. It has historically been a large holding of stocks by Warren Buffett, and for good reason. Aside from paying a dividend yield of 2.99%, which is higher than last year, having allocated $14.9 billion to dividends and $17.4 billion to stock buybacks in 2023. This resulted in a 3.6% reduction in the company's outstanding share count while also decreasing its net debt position. Another reliable business that does well in whatever economic climate is Johnson & Johnson. Whatever the case, medication is necessary for us to get better because health is an important aspect of our life. If you didn't know, Johnson & Johnson is known for its flagship brands, which include Zyrtec, Pepcid, Band-Aids, Listerine, Tylenol, and Aveeno. As a result, the company is robust to economic downturns and can weather any kind of recession. Elevated interest rates or high inflation, let's set that aside for a moment. Another reason we love Johnson & Johnson is that they have been a dividend payer for more than 50 years. Doctors still recommend Johnson & Johnson products to their patients. J&J is a pure value company that performs well in every category, especially over the long run. It has also continuously increased dividends to shareholders over time. Let this stock leave his portfolio. You should feel the same way. Since going public in 2008, Visa has continuously produced returns that beat the market, and the stock recently reached a record high. Despite inflationary pressures, sky-high interest rates, and volatile markets, Visa is still a great choice for investors. As we previously mentioned, in 2022, the company handled $14.1 trillion in total transaction volume, far exceeding that of its closest rival MasterCard, which processed $8.2 trillion. Visa also earns fees from processing payments for merchants. On average, it charges an average credit card processing fee of between 1% and 3%. However, what really sets Visa apart as a compelling long-term investment opportunity is its wide margin for growth management claims, stating that its network can support an additional $185 trillion in new volume with its account-based payments platform. With over 500 partners using Visa Direct and its commercial cross-border platform Visa B2B Connect, the company enjoys a strong network and competitive edge. As evidenced by Visa's profit margins, which averaged a remarkable 47% over the last 10 years, and slightly over $19 billion in free cash flow from the previous year, they had ample funds to repurchase shares, pay dividends, and invest in new goods. Perhaps this is why Warren Buffett said that many would love to take their customers away from them, despite having more than ever. Finally, but most definitely not least, is Warren Buffett's ultimate investment, Apple, which he described as a company better than anyone he owns. I know you're surprised that Apple made our list, but trust us when we say that it is the king of MOATS. Just look at him wax poetic about it. Apple is different from the other businesses we own. It just so happens to be a better business than any we own. Unfortunately, with a dividend yield of just about 0.56%. And in the event that they had to choose between giving up their iPhone and their second car, they would give up their iPhone. As you can see, Apple has made extraordinary profits over the past 15 years, and even though the company's most recent iPhone release didn't exactly receive a lot of attention, its brand name is still one of the most valuable in the world, encouraging people to keep buying its high-end devices. This, along with the fact that it has over 2 billion installed devices, highlights a robust and devoted ecosystem that presents many opportunities. Additionally, the healthcare industry is one where Apple excels. Apple Watch has several health-rated features, such as heart rate monitoring, while AirPods provide a hearing aid alternative. Apple may have recently shelved their long-held plans to enter the automotive industry, but their influence in technology is as strong as ever and is not going away anytime soon. In fact, we believe that it may even get better. In addition, the company is investigating the possibility of turning the Apple Watch into a continuous glucose monitoring device for people with diabetes. However, that is merely personal opinion. The data may indicate that Apple's dividend yield isn't as competitive as the S&P 500's, which is 1.54%. Nevertheless, over the last 10 years, the company has more than doubled its payouts, and its cash payout ratio is a cautious 14.8%. In conclusion, even though Apple doesn't have the highest yield, Peter and you should give it serious consideration for years to come. When it comes to this area, Apple is superior to most other companies, which makes it one of the best stocks to purchase and hold on to for eternity. Warren Buffett has always relied on compounding, making investments, and sticking with them over time. In conclusion, any investor hoping to assemble a secure and profitable portfolio must comprehend Warren Buffett's methodology for selecting 8 safe dividend equities that produce a monthly yield of $1,000. Buffett's tactics and ideas can help you become a better investor and possibly even guarantee a steady passive income stream. Remember to like, share, and subscribe to our investing tutorial channel for more informative videos and investment advice. Keep checking back for more insightful videos to help you confidently navigate the world of investing.